to invest in private equity as a retail investor. Private equity isn't just for institutions anymore. If you're a real estate investor, you now have more access than you ever have before. So let's break down how you can invest in private equity, even if you're not ultra wealthy. So what is private equity? Private equity means investing in private businesses that aren't listed on stock exchanges. It can include real estate funds, buyouts of companies, startups, private credit, and more. It's a way to tap into long-term growth and income outside of the public markets. So the barriers are falling. In the past, private equity was limited to accredited investors and big institutions. But now, thanks to new platforms and SEC regulations, individual retail investors can get in and invest. Minimums are lower and access is broader, and the opportunity is growing for private investors. So the first option, crowdfunding platforms. These start with real estate or startup platforms like Fundrise, CrowdStreet, StartEngine, or Republic. They can let you invest with as little as $500 or $1,000. You can access real estate assets, vetted businesses, and diversified funds. Option 2 is a Reg A and Reg CF offering. These are SEC-approved structures that allow non-accredited investors to participate. You'll find these on crowdfunding platforms or directly from fund sponsors. They offer exposure to private equity without needing $1 million net worth. Some private equity funds now operate like mutual funds or REITs. You can access them through a brokerage account with daily liquidity. This is a bridge between traditional investing and private markets. RIAs or wealth advisors have these type of investments in their portfolio. Option 4, private deals through relationships. If you're in investor communities and you work with sponsors, you may gain early access to deals. Some sponsors have lower minimums for friends and family rounds. Always vet the operator, understand the structure of the investment, and know your rights as an investor. I like to talk about the 6-point Jockey test, where you want to find out how much did they invest personally in the deal. Secondly, is the business clear and simple? Third, do they have a strong team and are they able to execute? Fourth, have they failed before? And if so, did they communicate it to their investors and how did they handle that failure? 5, are they focused on this one category? Are they clear that they're in this one lane and they're only working on this investment? And 6, are they fully committed? Are they willing to do what it takes because they have all the skin in the game in order to go after that investment? So what do you watch out for? Well, bad sponsors first, but secondly, it's private equity is less regulated. So do the homework. Understand the exit timeline. Understand the risk level. Get a clear picture of the fees and clearly know the sponsor's experience. It's important to look for transparency, consistent reporting, and clear legal documents. If you have an attorney, please have them review the documents. So final thoughts. Retail investors are no longer shut out of private equity. And you don't need millions of dollars. You just need to start smart. Start small, stay diversified, learn as you go. And remember, private equity is a long game, so think like a builder, not a trader. Many of these investments are 3, 5 to 10-year holds. So if you need the liquidity, hold off. These are illiquid investments. So if you want a list of vetted platforms and beginner-friendly private equity options, download my free guide, The Retail Investor's Private Equity Starter Kit. This includes platform links, investment checklists, and due diligence tips. Next up, check out my video on how to evaluate private equity sponsors. This is the Jockey and the Horse test, and this will help you avoid costly mistakes before you invest with anyone. I'll see you there.